Hi, good morning, everybody. This is Kang Wei here with an update on our US trading note monthly. Besides this, we're also going to do a introduction to our latest trading note on Synchrony Financial, and then we'll have Paul later to do a monthly Singapore market update. So today is going to be a relatively short one, so let's just get started. Okay, so on our US trading note monthly performance with the end of June, we've closed a couple of positions and we've opened a new one with Synchrony Financial. Let's just start with the open positions first. GNC Holdings was one of the, I think, the most volatile of our calls in this year to date, and it has since, I think, falling to a low of 6 point something, has recovered quite nicely to $8 plus, still slightly below our entry price initially, but I think that the improving financials for the company has forced some of the short sellers to get a bit of a short squeeze out of their positions. So with the improving financials to the company, we continue to maintain it as an open position, and we will continue to monitor, but do note again that this is one of the more volatile stocks in our holdings. Synchrony Financial we'll talk about later. For GameStop, it has, I think, since their latest earnings fallen a bit off from our position of profit earlier, but we continue to believe in the transition of the company away from its traditional second-hand gaming market, and believe that with upcoming new consoles such as the Xbox Scorpio and a potential PlayStation 5, that there are some catalysts in the next couple of years that could help the stock to do a turnaround. So we'll continue to maintain holding this position. For the closed positions, these open and closed positions from our trading notes is just a summary of the positions on our trading notes that we've had to date so far. For the for the closed positions, recently we closed Nvidia on 17th of May, seeing that it's run up quite a bit, and we decided to take our profit there. Advanced Micro Devices, AMD, as well as also hit our target price on the 23rd of June, and we decided to take profit there as well, as there's going to be a bit more volatility coming up. So A-Flag also, we decided to take profit when it hit our target price on the 9th of June. So overall, you can see that the performance compared to the major indexes for the US year to date, we are performing quite well compared to the S&P and Dow Jones. Most of our positions also around the NASDAQ levels. Okay, with that, let's go and talk about our latest trading note, Synchrony Financial. Just to give a bit of background, if you have not heard of this company before, Synchrony Financial was actually GE Capital that was spun off about 2 years ago, and they are the largest private label credit card company. They are a consumer financial loans kind of company. And they have partnerships with a lot of various companies that you can see on the PowerPoint presentation here. Partnership with Walmart, Amazon, Lowe's, Gap, JCPenney, and they also operate primarily in retail cards, payment solutions, and care credit, which is the financing for health and personal care procedures, products, and services. So let's talk a little bit about their recent price action and why we think that this is why we initiated a trading buy. So on the 28th of April, as you can see from the chart here, there was a gap down, and this is because they reported below expectations for their earnings. It actually tumbled down almost 20% after the earnings period. Because they reported an EPS of 0.61 versus analyst expectations of 0.74. And part of the reason for this below expectation was because they had to put a bigger than expected amount as a buffer into their bad and doubtful debt provisions on fear of issues with their rising credit risk of the loans that they are making out. Now, if you're familiar with GE Capital, during the global financial crisis, GE Capital actually was in ran into a lot of problems when a lot of people a lot of their clients were not able to service their loans, and so much so it actually brought the entire GE into a bit of a crisis period, actually dropping their share price from like close to 30 odd dollars down to $6 at one point in time. And so with that kind of history, I think that investors were very fearful that with the rising credit issues in the US, that it might cause a similar issue with Synchrony Financial, and especially such now that they don't actually have the GE compound, the company to shore up the GE Capital. But overall, we feel that this fear is a bit overblown, and as we'll talk about later on, we feel that Synchrony Financial has been able to take certain steps to shore up their balance sheet, and yeah, so we feel that the sell-off was overdone, and seems the market is realizing as well, as since the fall from the reaching a bottom of about close to $26, they've actually managed to recover half of their pre-earnings price, going back up to about 29.55 as of Friday, or rather as of Thursday last week. I think as of Friday it's 29.8 something now. Okay, so why do we initiate a trading buy on this company? One of the growth reasons we feel is that they are the largest private label credit card provider. If you're not familiar with if they're not familiar with private label credit cards are essentially like a store-owned credit card. Imagine your Amazon Store Prime card or your Cathay Pacific card. These credit cards are usually only usable with the company stores itself. So you can't use, for example, your Amazon credit card in a Walmart store, for example. And Synchrony Financial actually is the provider for such private label credit cards. And usually these kind of cards, the companies will give some incentive in order to draw clients to apply for their card and to use their card in the stores. For example, maybe they give you 5% cash back or certain discounts for using their own store credit card. So Synchrony Financial, SYF, actually has over 40+% market share, and this is up from 34% in 2011. So you can see that it's growing up. It's growing at quite a reasonable rate. And private label credit cards actually accounted for 40% of all cards issued in 2016. So you can see that it is quite a sizable market, and of this sizable market, Synchrony Financial actually holds quite a sizable share in this private label credit card. So as mentioned earlier, they actually partner with Amazon, Cathay Pacific, Walmart, Lowe's, Gap, and etc. Quite a lot of different companies. And why we feel that this is a potential growth point for SYF is that as consumer trends tend towards more online spending through your e-commerce or online shopping, I feel that more and more, first of all, the fact that clients are going to use credit cards more often to pay for online purchases is a plus point for credit card companies like SYF. But as more and more companies are trying to get some brand loyalty to, for example, Amazon, you're trying to get more clients to get signed on to your credit card and then stick to your brand to do your online shopping. We feel that this actually benefits SYF more. So you can see in the bar chart below, this was a survey done by Morgan Stanley, which showed that Amazon Prime members tend to spend about 4.6 times more than non-Prime members. So it's actually in Amazon's interest to actually try and expand their Prime membership as much as possible. And if they are able to do so and get more people spending an equivalent amount compared to their non-Prime members, then this is going to benefit SYF, and SYF is going to be in a very good position to increase the kind of transactions done through their credit cards. Now, as I mentioned earlier, part of the reason for the drop in share price, one of the reasons was the fear of their asset quality with regards to their loans. So if you're not familiar with FICO is a type of credit score used in the US, and scores above 650 indicate very good credit history. Usually if your score is below 650, then you're considered a subprime. Scores below 620 actually indicate a very poor credit worthiness, and there's going to be difficult for a lot of these clients with poor credit scores to find loans at a favorable rate. So you can see since 2008, after the GFC, the number of clients that are in the subprime category made up about close to 39%, 40% of the type of clients that GE Capital at that point had. And as of the latest Q1 2017, SYF has managed to reduce this number of this percentage of clients from that close to 40%, now close to 30%, 10% reduction. And this wasn't done through kicking out the clients, but rather they focused on growing the clients with good credit scores. You can see that the 660 and above has actually grown to from 28% to 38%. So overall, we feel that SYF has taken great steps towards improving their asset quality, and they continue to seek to improve that asset quality. And as they continue to do so, we feel that even if there's rising credit risk, SYF has been able to well, stack the odds in their favor. Besides that, you can see in the table below that based on Basel III requirements, if you're familiar with Basel III, Basel III is actually a regulatory accord that was designed to improve regulation and risk management. This was updated and introduced after the global financial crisis to ensure that banks maintain a proper leverage ratio so as to meet certain minimum capital requirements to be considered well capitalized. So under Basel III, there's certain categories such as adequately capitalized and well capitalized. And you can see that in comparison for SYF versus what is the minimum requirement to be considered well capitalized under Basel III, SYF has actually exceeded way above beyond what is necessary to be considered well capitalized for under Basel III. You can see as of March 31st, 2017, their total risk capital ratio is about 17.3%, well above the 10% minimum required for the total risk-based capital. Yeah, so overall we feel that based on what they have done, they've taken steps to beef up their buffers, so they are well capitalized, they are less at risk should a credit crunch, global financial credit crisis happen again. Besides that, SYF has also performed very well compared to its peers. If you're not familiar, SOF is for Capital One Financial, DFS is Discovery, and AXP is American Express. So you can see here that in terms of, for example, loan receivable growth, purchase volume growth, risk-adjusted yield, all of this, SYF has performed well above a lot of their competitors. But even with that, in terms of PE valuation wise, SYF is trading at either below or not really having their exceptional growth being priced in. In case you're not familiar with financial terms for banks, the efficiency ratio here is low, and that's a good thing. It represents how efficiently SYF is able to convert assets into revenue for their company. So being the lowest among them, that means they're the most efficient. So we feel that based on the PE ratios wise, SYF seems to be relatively undervalued compared to its peers in terms of the PE ratio valuation relative to the amount of growth and efficiency in terms of generating revenue from their assets. So all of this leads us to feel that to issue a trading buy on Synchrony Financial. We put a entry price of 29.50 and a stop loss of 26.5 with a target price of $35. You can see at the corner of the table here where the Bloomberg consensus target price was 35.65. So we decided to discount a little from that because we feel that certain analysts in Bloomberg may not have fully updated the risk with regards to the credit yet. But even with that said, the 3 points that we want to bring across is that they are the dominant private label credit card provider in a space that we feel should continue to grow. They have been improving their asset quality and they are very well capitalized. So fears that they will have issue come the next credit crunch, come if there is a next credit crunch, while not unfounded, we feel that the fears were quite overblown, and that they are also undervalued compared to their peers. So overall, that leads us to issue a trading an entry into this Synchrony Financial. So with that, I will pass the time over to Paul to talk a little bit about the monthly strategy for the Singapore market.
Yeah, thanks, Kavin. On our Singapore strategy for July 2017, we maintain a neutral on our STI with an STI target of 3270. This is unchanged from the prior month. As you can recall, our STI target it's bottoms up based off the price targets of our various stock recommendations. In terms of the outlook, it is worth noting that it was quite an eventful month in June. There were a few, the US 10-year treasuries hit a year low. We also had a decline in oil prices. In terms of the macro backdrop that we need to be mindful of, we saw a big inflation data which pushed the US Treasury yields lower. This was despite the Fed raising rates and even the Fed forewarning of their need to unwind the balance sheet. So the US Treasury yields declined despite these two events, which is predominantly due to the weak inflation outlook by the market. Another major macro event was, of course, the Macron majority in Parliament, and that kind of removed political risk in EU, and to stretch it a bit further, we had Merkel making some comments on of a consolidated Euro budget, which kind of rekindles this fiscal union kind of dream. And the other macro, it was the softer US data, and we also see this in Asian export numbers, especially in Singapore and in even Taiwan, Korea, where electronic exports is beginning to taper down. And also this softer US data and politics is also pressuring the US dollar. And if you recall from our note from Jeremy, where we see a 30% downside to the US dollar. And the final point is also, of course, the breakdown in oil prices, which raises credit risk, which especially could a little bit on the Singapore banks, but the larger part of the credit risk due to oil prices has already been kind of have already occurred last year. In terms of our stock strategy, our strategy is to buy sustainable yield. We had buys on Croesus, but obviously for obvious reasons we've taken that out. And also our Capital DC REIT has the share price has performed far ahead of our price targets. So our yield picks is Asian Pay TV and also Maple Industrial. Maple Industrial has more than 90 properties, which could help on our team of buying sustainable yield. In terms of sector picks, we are overweight on the property sector. We see supply at more at 10-year lows, while demand is up almost 50% to 60% year to date. So that means we have a very favorable demand supply dynamics. In terms of our top picks, we have Capital Land, Chik In Seng, Cinemas Land for Indonesian properties, and also we have a trading buy on Willow properties. Yep. Thank you.
Okay, with that, we've come to the end of the presentation portion of today's webinar. If you have any questions, feel free to type them in and we will try to answer them. Okay, we received a question that asks, during the financial crisis, G Capital price plunged, whether we still have confidence to enter into this stock now. So, as mentioned earlier in the presentation, part of the reason for G Capital's drop in share price was because of um, the idea that, because you could see there earlier in 2008 that the number of subprime clients were actually below, will actually make up almost 40+% of the portfolio of their asset quality. And since then, SYF has taken steps to try and reduce this as a total percentage of their portfolio. So overall, they're taking steps to reduce the subprime type of clients. So in the event of a credit crunch, these clients will affect the portfolio less, as well as the fact that they are well capitalized again, so they have a pretty good buffer that will not basically bankrupt the company in the event that these clients are not able to service their loans.
Hi, good morning, guys. Teo Hong here. There are questions on our target prices for all the property stocks we listed. So we have a more comprehensive list of all the stocks under our coverage, including the ratings and the target prices on our daily morning note. So you can refer to that for all the target prices.
Yeah, hi. This is Paul here. We have two questions on Asian Pay TV. The first is, what kind of upside potential would Asian Pay TV fetch? Our price target is 64, and together with their current yield of 11%, the total cumulative upside is almost 20% for Asian Pay TV. That would be the first question on the upside potential. The second question, when I look at the historical DPU of Asian Pay TV, notice that it has been falling. Why do you say it's sustainable? Okay, firstly, that's why the share price corrected. When it got listed, there was a lot of exuberance and excitement on this stock because it was paying about 8% yield. But the yield dropped because the authorities cut the broadband monthly payouts by $1 or $2 a month, and the other reason was they had to accelerate the capex spend on their digital set-top boxes. If you can recall, there was a plan to roll out this digital set-top boxes, but of almost 100 million. But this was supposed to be over a couple of years, but the authorities wanted to speed track that. So as a result, they had to conserve cash and cut their dividends. And why do I say it's sustainable? Well, the dividend is sustained over their 700,000 plus subscribers. And Asian Pay TV, it's almost like it's actually more of a monopoly. You can say Asian Pay TV is like your StarHub cable without the mobile. They basically own all the cable connections, the physical infrastructure. So no one else can actually roll out cable unless they have a similar infrastructure like them. So that's the reason why it's sustainable for this year and next at least. Yeah. Thanks. Yes, we have another question on the Asian Pay TV. Will Asian TV earnings be sustainable going forward, taken into account Taiwan's unemployment at the near term? Um, the, okay, the key variable to monitor is actually the subscriber base, and that hasn't dropped for the last 10, I think 10 to 12 years. Because the subscription it's I think about US $16 a month, and you get 100 channels, and it's quite a culture in Taiwan to just do channel surfing, you call it, yeah. So yeah, there is unemployment, but these are, you can call this like essential entertainment that most Taiwanese turn on, and this is the main channel medium where you can get this 100 plus channels. And with the improvement in the electronic exports, actually this unemployment rate could actually be reversing. Yeah, thank you. Sorry, there's another question on APTV. Are they using cable or fiber? This is essentially cable. Again, just to reiterate, this is like your StarHub cable. I mean, if you do own StarHub cable, it's purely a cable connection. Yeah. Thanks. Yeah, hi. Thanks. There's another question. Asia Pay TV's biggest market share in Taiwan. Okay. In Taiwan as a whole, they are, I think, the third or fourth largest. But that's not well, that's an important metric to note of. But the more important thing to take note of is the area where they operate. Because just to give a bit of history, uh, prior to the last 1-2 years, the whole of Taiwan was kind of like carved out. There was like, if I'm not mistaken, sorry, about 50 over areas. So everyone had their own areas to operate, their own monopoly where they roll out the infrastructure. So the Asian Pay TV had theirs in the northwest of Taiwan with about 700,000 subscribers. So most important is their market share in that area, and that is probably like 100% because they are the only ones who's rolling out cable TV. Yeah, but just to answer that question, I think they are the third or fourth largest in the whole of Taiwan. But more important for me is in the area where they operate. They are the only provider in that area. Thank you.
Okay, if there's no further questions, we will bring this webinar to an end. You can subscribe for the webinar as well as view this one once it's uploaded on our archive. Thank you.